Good evening and welcome to the live stream event on the 4th of May 2021. I'm still recoiling from my mistake with Star Trek and Star Wars. You know, it's like a divided house, isn't it? Some people love Star Trek, some people love Star Wars. Anyway, great to see you all here on the show tonight. Got a big show again. A lot going on with the main data sets that I'm going to share with you tonight. A lot of other information just come out today as well, so we'll go through some of that. And as normal, with all of this, we'll just quickly go through the intro slides and just get everybody on the same page. Just the running order, we'll do this introduction, the house rules, about my models, and some key slides. And then we'll do some questions and answers. Most of the show will be your questions and answers, so have them ready for me. And once we've done that, we'll sign off. And in terms of the house rules, as I always say, please note this is not financial advice. We don't do financial advice. We can talk generally about trends and data and analysis, but I'm not a qualified financial advisor, so I don't give financial advice. It shouldn't be construed as such. It is, of course, moderated on the chat, so if we have any rubbish on the chat, we will moderate it away. This is as at the 4th of May 2021, and if you want to get my attention, do use that Walk the World just to make sure that I see your comment or question. I've also enabled Super Chat, which means that firstly you can make a contribution if you would like to help support the channel, but also make sure that your question goes to the top of the list. So the Super Chat is enabled for tonight. And as with always, when I start my shows, I just spend a bit of time talking a little bit about what we do and how we do it, because there may well be someone who've never seen this before. I know that's hard to believe, but we survey households all the time. Data came back today. In fact, it's in the model now. And that gives us a 52,000 household sample, and that feeds all the analysis that we do. So this is very much data-driven, pull information from multiple sources. We can slice and dice the data multiple ways through our segmentation. And the core market model then allows us to think about different scenarios and different potential futures. So we'll talk about some of those. And also, of course, powers our price scenarios, where we take the mortgage stress, the price trajectory, the buying and selling intentions, the migration information, economic data, put it through the core market model and the scenarios, and we can then come up with a view of what prices might be doing at a postcode, state, region, or all Australia level. And I guess the first thing to say is that RBA holds again. No surprise there, but it's interesting just to see what they said. Maintain the current policy settings, target of 10 basis points, and the 3-year bond purchase program. Economies continuing to recover from the pandemic, outlook for strong growth this year and next. And then they said the recovery remains uneven, of course. Global trade has picked up. The sovereign bonds yield steadily have increased. Inflation expectations have lifted from near record lows to be close to central bank targets. The 3-year government bond yield in Australia is at the board's target of 10%. And the economic recovery in Australia is stronger than expected and is forecast to continue. So there you go. Unemployment falling to 5.6% in March, which of course is possibly now moving towards pre-pandemic levels. And central scenario for GDP revised up and is now 3.5% in 2022, but 4.75% over 2021, so that's pretty strong. They're also expecting a pickup in business investment, and the unemployment rate could be down to 4.5% at the end of 2022. Well, maybe. Interesting question as to whether that is actually realistic and feasible. I have to say that in some ways it still seems to me a bit of a long bow, but we'll see. Just want to acknowledge Jason there. Thank you very much for your contribution. Really is appreciated. And just continuing my conversation with the Reserve Bank, they said despite the strong recovery, it's subdued in parts. Pickup in inflation and wages expected, but it's unlikely to be anything but gradual. Inflation underlying terms expected to be 1.5% in 2021 and 2% in mid-2023. In other words, no inflation here. CPI inflation is expected to rise temporarily to be above 3% in the June quarter because of the reversal of some of the COVID-related pricing reductions. And that's actually quite important because a lot of the discussion around the world is how much inflation is there really. And of course, when you remember where we were a year ago, there was a very significant negative dive in CPI and inflation. And then, of course, it coming back, you would expect it to be quite strong. But that is those transitionary numbers rather than the structural inflation. And so I'm still to be convinced that we're really seeing structural inflation, although there are odd price rises across the supply chain. But we'll see about that. It's also worth pointing out that they're talking about the term funding facility. This is the very cheap money to banks. They're going to stop it at the end of 30th of June as expected. There was discussion a little while ago as to whether they might extend it, but no. But it still gives the banks 3 years of very, very cheap money. 0.1% money, very, very cheap. And that means they'll be able to keep their loan rates down quite low if they choose to. And they also made the point that they're going to increase the cash rate until actual inflation is within 2 to 3% target range. And they're saying the labour market needs to be tight to generate wages growth, which takes us right back to that conversation from Frydenberg when he said, well, you know, it's got to be probably 4 point something at least. And the question is it feasible to get to 4 point something? And if we do, would it really have any impact on wages growth? And my answer to that is it depends on migration. If migration is up again, no. If migration is still relatively slow because of the borders shut, possibly. So that's another factor to throw into the mix. Now, if I just take a wider view here, I want to sort of just highlight this chart. This is actually an 80-year view of US rates. And you can see that they peaked in the 1980s. This is pretty consistent with all rates in all countries in the Western world. Around that area, of course, we had Nixon taking the dollar off the gold standard, and we had roaring inflation, which included very strong wages growth there. But we've seen a secular decline since then. And in fact, if you look carefully, each time there's been a recession, rates have dropped in 2008, 9, 10, dropped earlier on in the 2000s, and then previously. And we've seen the same again there. So the question is this significant, this long, slow rise up and rise down? Because if it is, then the key question is, what happens next? And there are people who think that actually we are coming to the end of this long cycle, and the next step is going to be the key question. Now, I've posed the question. I won't answer it necessarily tonight, but in an upcoming post, I'm going to look at the alternative futures from this point, because I do believe this cycle is very significant. Inflation was very high here, in fact, ragingly high, at 16, 17, 18%, of course, in times. Inflation is almost nowhere here. And the question is, with interest rates very, very low, is it really likely that we're going to see strong inflation? That's the question which I think it's worth thinking about, because for me, that's one of the critical connections that many people aren't drawing. Now, in terms of other news, I thought there was a very good article by Terry McCrann, who basically made the point that Westpac's so-called tripling of profit was just a statistical blip, really. Its real operating profit was actually down about 16%, and that was because they were able to pull back a whole bunch of loans that were actually effectively provisioned, and then they actually pulled them back. So there isn't really massive good news in the Westpac results. And I'd also make the point that the margins to depositors dropped much more than the margin on loans, nearly twice as much. So most people with deposits are getting absolutely nothing from Westpac, or indeed the other banks. And the other interesting observation in the numbers and in the presentation was that the 90-day delinquencies for mortgages were up a little bit, and they're actually saying they expect that to go higher. Why? Because they're now at the end of the support mechanisms for all those people with the deferred interest and principals. And of course, there are still people struggling. And I'll show you in my statistics shortly how this translates into real action. So I think it's really good to read this and put in context what's really going on. This is not, of course, what most of the mainstream media reported yesterday. I'll also just point this one out. This was quite a useful summary to make the point that people seem to have got a bit comfortable on job seeker, they're claiming. And so people are a bit lax to come and get jobs. Now, whether that is true or whether it's more to do with the hassles they have to go through to shift and get back into the workforce, or whether it's the fact that the hurdles they have to jump to be able to get job seeker is an interesting question. But of course, they've now brought back in much more rigorous testing of people's application processes for jobs, and there's a hotline so that people can actually dob on people who aren't responsive to jobs they're offered. So unfortunately, there are a number of people who are really struggling, I think, and the jobs question is a very interesting one. We'll watch this, I think, as we go ahead. Then if I just take the next slide briefly, this was from Patrick Cummins before the RBA came out, so he was on the inside track and basically saying they're going to forecast full employment in a couple of years. Well, it's 4 point something. The other interesting observation they made was how bad the forecasting has been, and they also spoke briefly about the fact that there is a cooling of home price growth frenzy now, and that was, of course, relating to the CoreLogic statistics, which everybody probably has seen already. So maybe things are in transition, and there are a few transitionary things, I think, beginning to happen. And then the other interesting observation, this is from James Kirby, was that first home buyers are now beginning to get squeezed out again as probably investors are moving back in. And, Shane Oliver said that while first home buyers led the initial recovery spurred by various incentives, home finance data suggests that home buyer activity is now peaked and investors are jumping to take over. And that's obviously to do with some of the more recent movements in terms of property prices. And, prices were reasonably strong, but nevertheless, not as strong as some people thought. And I have to say that ahead, it could well be that we're going to see more patchy performance of property as we go forward, but we'll see. So I thought that was quite interesting. Also, the clearance rate is still strong according to CoreLogic, nearly twice the rate of last year. But the question is that really the true picture? Well, maybe not. Now, if I then take this forward, this is from SQM, so this is the data that came out today from SQM, and they made the point that nationally new listings, less than 30 days, fell 2.8% over April, with around 81,000 properties on the market. But they are 57.5% up over the year. Hobart's new listings dropped the most, down 16%. Canberra and Sydney went against the trend and posted heavy rises of 10.7 and 4.8. And over the year, new listings rose the most in Darwin by 177.6%. And also makes the point that some older stock is clearing, with listings over 180 days down 1.3% and down 33.4% over the year, with big falls posted in pretty much all of the capital cities. Now, I think that's quite interesting, that change, but I just want to highlight the contrast between Sydney and Melbourne, where listings are definitely higher than a year ago, and other places where they're not. And again, it shows you have to go granular. And SQM also said that over the 30 days to May, asking prices rose by 2.6% for houses and 0.2% for units. Over the year, asking home prices for houses, 11.8%, led by gains in Hobart. Sydney is catching up now. Healthy rises in asking house prices in Brisbane and Adelaide. Asking unit prices up 6.1%, but that was pushed up by rises in smaller capital cities and regional locations. Capital City asking house prices rose 5.2% over the year to the 4th of May, while unit asking prices are down by 1.8%, reflecting falls in asking prices for Sydney units of 5.1% as oversupply swamps the market. So this is, again, very important to understand. There is a considerable shift between units and houses and various centres. So again, you have to go granular to really go into some detail to understand what's going on. You can't just talk about averages. Now, the other interesting piece of data that came out today was from NAB, which is suggesting that the demand of new and established properties for foreign buyers has fallen through the floor. We're seeing it in our data too. In fact, foreign buyers are selling quite hard, and that's one of the reasons why we're seeing some types of property. And interestingly, if you look carefully, quite a lot of those are actually units. So one reason why we're seeing more units listed is foreign buyers selling those properties. The ABS data today showed that the commitments for new loans in the month of March was a new record of $30.2 billion, up 5.5%, and the value for investors were up 12.7%. This is new loans to $7.8 billion in March, and that was 54.3% higher than in March 2020. The rise in March was the largest recorded rise since July 2003, and increasing loan commitments to investors for existing dwellings. So, question is are investors back? Well, maybe some are, some aren't. Owner-occupier loans rose a little as well in terms of new loans, and that was driven by an 8.8% rise in the value of loan commitments for existing dwellings, and the value of owner-occupied loans fell 14.5% for construction. That's the first fall since the home builder grant was introduced. That's because we had a lot of pull forward, which is now dropping away. So some interesting movements there, and I guess that'll be in the papers tomorrow. Record highs everywhere, but just remember, this is the new stuff. Remember, there's also old loans being repaid. First-time buyers slid a little, down 3.1% in season adjusted terms, and it was about 5.1% of all first home buyer commitments, and the owner-occupier first home buyer commitments accounted for 33.7% of all owner-occupier commitments, and that for 5.1 was for investment purposes. So you can see a bit of a peak, a slight drop. Now, the annual credit numbers from the RBA a couple of days ago showed that, in fact, owner-occupation growth was a little stronger. Business credit was significantly down 2.6%, and investment lending was just up a little. Personal lending was sort of still falling, but less quickly. And so the point there is that whilst all this new loan stuff is being written, old loans are still being repaid. And in fact, in my surveys, the amount of loans being repaid is still very, very strong. And that's because people have the money to pay down, are in some cases choosing to pay down because they're worried about the future trajectory of the economy ahead. So it's an interesting mix. And unfortunately, again, we don't often hear the true story of the pay down side as well. The ABS, unfortunately, doesn't tell us anything about the loans that were actually paid down as well. And just worth recalling that the aggregate data showed broad money was still up. Of course, we dropped off a lot of the broad money that was injected in March a year ago, so it's down to 9.57, still very strong. All credit was 1%. So let's be clear, a 1% credit growth over 12 months across the whole of the economy. That is not inflationary territory. That is clearly not. And once again, I think we should be cautious about claiming that everything is booming. That said, if you look at the sort of the other data more broadly, in patches there might be some peaks and some rises, but overall it's not quite so strong as many people say. Now, if I move on to mortgage stress, so the mortgage stress was higher again. So remember, this is cash flow, this is money in, money out. So we've got 41.1% of households who are in mortgage stress. So that's higher than where we were a couple of months ago. So the end of JobKeeper, JobSeeker has definitely had an impact. Still, of course, more or less 10% higher than in February 2020 before COVID. So that's the significant factor there. And the household debt ratio is still 180.4. So it's still an issue. And if you then go into detail, you can see there that from the stress perspective, average mortgage stress 41.28%. That's mortgage stress of 1.52, so that's slightly higher than last time. The rental stress is also slightly higher. Unfortunately, rental stress is a real issue. 35% of those in rent are struggling, and that is actually 1.7 million households in rental stress. And just to complete this picture, investor stress, across the states is at 25.94, and that equates to about 846,000 investors who are under the pump. And overall financial stress, so that's people in all those categories who have cash flow issues one way or the other. It's about 4.1 million households out of the total household pool of 9.7, so that's 37.9%. So it's a significant proportion, and I've seen other data recently that shows quite similar figures to mine, which is suggesting that about 1/3 of households are in financial difficulty across all those categories. So there's 2/3 doing fine, or in fact probably 1/3 doing really well, 1/3 doing okay, and 1/3 not doing particularly well. It's a big number, and unfortunately I don't think there's being enough attention given to the ones in difficulty. And of course, in true fashion, Tasmania seems to come out on top in terms of mortgage stress at 55%. In terms of average rental stress, it's 48% in New South Wales. It's 36% in Victoria, other states slightly lower. In terms of investor stress, there we see New South Wales and the ACT taking the lead. And overall financial stress is highest in the ACT and New South Wales. Victoria is pretty high at 38%. And all those three are above the average of the country. Now, we can then move on and look at the overall information by segment. And again, I've got the same sort of information, so the totals add up. But just to make the point that if you look at mortgage stress, young growing families and first-time buyers is where a lot of the action is, 76%. That's a significant number who are in some degree of difficulty. It's also worth highlighting that some of the other stress areas on the outskirts of town, the battling urban, the disadvantaged fringe, those are the new high-growth corridors, are also significantly in stress as well. If you look at rental stress, well, there a lot is actually in those multicultural corridors, as well as the young affluents, closer into town quite often, the young growing families. And have a look at investor stress, you can see there that young affluents lead the way, followed by exclusive professionals. Now, in some cases, that's because they've got multiple properties and they're struggling with finding people to rent all of them. And the costs, of course, mounting up with rental yield. I'll show you some rental yield stuff shortly. So overall financial stress, you can see it's pretty evenly distributed, but overall, young growing families and the young affluents are at the top of the list. They are the people who are finding it more difficult than anybody else, but there are others as well. And if you look at the numbers, just the sheer numbers, you can see that the suburban mainstream, although it's a relatively low proportion, it's quite a few in that category, because that category is a big category. It's slightly bigger than the disadvantaged fringe segment. If I then look at the mortgage stress by postcode, I'll just quickly highlight the top ones. 2170, so that's places like Liverpool at 68.1%. Tapping, WA, which includes quite a few, Wangara and Wangaroo, all places like that. Hocking at 65%. Toowoomba at 62%. Narrawarren and Fountain Gate, 74%. Berwick and Harkaway, 85%, so that's a very high one. Hoppers Crossing, and 43%. And then we go to Ballarat at 79%. Sydenham in Victoria at 70%. And so it goes on. Now, the point here, most of these are high-growth corridors where the mortgage stress is the highest in terms of the percentage. I've actually sorted it, though, in terms of the number of households. So 10,000 in and around Liverpool, 10,000 households in difficulty. And that's up from last time. Now, if I look at rental stress, a bit of the same story. Melbourne, central Melbourne, Victoria, 3,000 has the highest proportion in rental stress. 12,000, which is 67%. It's the highest count, not the highest proportion. I misspoke. If you look at places like Mount Druitt and Lethbridge Park, and places like that, 2770, that's got 8,000. And then we can go down to other New South Wales areas. And then the Central Coast, West Gosford, definitely in difficulty. Blacktown, South Yarra, Toowoomba, and even places like Surrey Hill, which you might find a bit surprising. But there you've got quite a few more affluent households renting property with higher rents. So that's a significant story. If we then look at investor stress, and then we can see that we hit Bundaberg and places like that with stressed investors, then Surrey Hills and Darlinghurst. Again, that's an issue to do with many rental properties still vacant or not actually washing their face in terms of the total costs. We can also look at places like Meadow Springs and Mandurah. There's no surprise there. And so it goes on, Westmead and Wentworthville, Melbourne 3000, another stressed investor area. And so it goes on. I'll also highlight this one up at Southport on the coast there, just around Brisbane as well. And then places like St Kilda, Crow's Nest, and even South Bank. So that's where we're seeing some of the pain. And then finally, if we take financial stress overall, the most stressed postcode across all categories in terms of the number of households is Liverpool. That's 20,000 there, 2170. Toowoomba, 19,000. And then we come to Lethbridge Park and Mount Druitt, 16,000. Central Melbourne at 16,000. Hoppers Crossing at 15,000. Wentworthville and Westmead at 15,000. And so it goes on. Cranbourne, 15,000. And it's pretty repetitive, you might think, insofar that this is pretty close to what we've seen the last few months, but the numbers are actually slightly higher compared with last month. So the first signs of stress post JobKeeper and JobSeeker are coming through. Now, let me just then switch over and I'll show you some of the stress mapping that I've done. This is actually Melbourne, and I'm showing this time the mortgage stress household counts. And you can see there how it's hitting some of those outer areas, so around the Dandenong area, around Point Cook, places like that. And also if you go over to Ballarat, you can see it there. So you can see the hot spots. It's also worth then highlighting some of the northern areas, not quite as severe, but still on the list. And in fact, if you drill in towards the centre of town, you can see that there's a bit of a patchwork even closer in, with places like Epping registering some issues, as well as a few others too. Some areas closer in not doing quite so badly, and that's partly because the rental scenario is a bit different. But if you come in closer still, and you then start looking at some of those areas close in, you can see a few wobbles there as well. So it's quite interesting just watching that. Now, if I then go to, let's go to 2000, which is obviously Sydney. We'll just go there. Okay, so if I pull out from the centre of Sydney, you can see that there are a few interesting areas quite close in from the centre of Sydney. Bellevue and Point Pinter look pretty good, not surprisingly perhaps. That's obviously where affluence lives. But if you start pulling out, then you can begin to see some quite interesting trends in terms of the way that this is actually moving. And interestingly, the red really comes in Western Sydney. That's not altogether surprising if you've followed my earlier discussion with regard to the postcodes. There are a few which are worth noting at closer in, but really it's mostly Western Sydney where you see the real pressures here. And that's where you've got the large counts, where you've got the high growth areas, lots of development, Blacktown, Glenwood, places like that. And obviously Warwick Farm, Liverpool, and then down towards Campbelltown. So all that western suburb is where a lot of the pain is. And remember, I'm looking here at the household counts. Now, if I then just quickly do another one, let's go over to Brisbane and go to 4,000. Brisbane is quite a different story because effectively there isn't too much to see close in. But if you then pull out, you can see quite a lot of areas beginning to pop up. And if you pull out a bit further, you can see quite clearly that there are some hot spots around Brisbane to the north, to the west, and other areas too. Not as severe, but nevertheless, if you look around Ipswich, there's quite a significant count there. So again, hot spots in a number of areas, but not universally true. And I will just do Perth. Because Perth is moving quite quickly with all of the recent sales that have been going on. And so if I go from the centre of Perth, you can see again some pretty blue areas close into Perth, not too bad at all. But if you pull out a bit further, you can begin to see some of the more stressed areas popping up. So the urban fringe, north and south Wanneroo, places like that are definitely registering there. And if you look at south of Perth and north of Perth, you see the same old story. And those are the high growth corridors once again. So that is very much a story of high growth corridors. Now, I'm just going to switch to an alternative view. Whoops. Hang on. Let me just go there. Open recent I want. Recent files. Okay. I'm just going to show you the net rental yields, because this is actually a piece of analysis that I've done which highlights the pressures. Now this is net rental yields. Now let me just make it clear, this is looking at the real returns on investor properties in my surveys, looking at all of the costs coming in. So that would be mortgage costs, strata fee costs, management fees, maintenance, all of those things, and the rental streams that might be coming as well. Putting them together and seeing whether people actually had sufficient to cover their costs on a cash flow basis. And it also takes account of those who are trying to sell and can't sell, and are trying to let and can't let. So all that data is included. So here you can see the rather unfortunate story that the net yield for some areas around Melbourne are negative. Not deeply negative, but underwater. So that means that unless you see significant capital growth, property investors are not making anything. Now, most property investors, when they actually think about property investing, don't consider net yield. They just think gross yield. So that's the price of the property relative to the theoretical gross rental. And they put one against the other. That's the way that the real estate industry spruiks it. But that's unrealistic. It doesn't give you anything that's real. This is the real way to think about it. This is before tax, by the way. And so this is the real problem we've got. We've got a lot of properties in this area which are really in some difficulty. Now, if I then go to Sydney and just draw a comparison for that, oops, it is quite interesting because Sydney does have some red areas, okay, which is perhaps not surprising, relatively close in to the city in particular, but it's not quite as red as Melbourne. I'm going to pull this across in a second. Let's go that way. There you go. But still, you'd have to say that rental yields in and around Sydney are also looking pretty wobbly too. And of course, Western Sydney is where a lot of the pain is. That's where a lot of the big losses are, which is why we said earlier on a lot of property investors are trying to sell. If I then go to Brisbane, Brisbane is a rather different story. Here you've got significantly higher returns. So basically Queensland rental properties are doing a lot better than those in Sydney and Melbourne. That's no surprise, given the fact that we know a lot of people have actually bought in Brisbane and surrounding areas from Melbourne and Sydney. And you can see how it plays out. There are a few areas where there are a few pain points, nothing really serious. But this is a whole different ball game compared with what we saw earlier on. Now, there are a few areas where you start seeing some problems, but really hardly anything. So the moral of this story is, if you're thinking of investing and you're thinking of returns, probably worth thinking about anything other than Sydney and Melbourne. Now, if I go to Perth, rentals there, let's have a look at those. Interestingly, around the centre of Perth, not too bad, but if you pull out, you then start seeing some problems. And that continues to be one of the big challenges that we have, with considerable numbers of properties still underwater even now. Now, in Perth, quite a few people have been given notice to quit and move out, and they've started putting rental prices up. So that may have an impact later. And of course, prices in Perth have been, languishing for a long time. Rental investing has been pretty chronic, and in some cases the average price and the average rent's 30% below where it was a few years ago. So what I'm saying to you is you have to go granular to really understand this. Now, I've just used aggregate data here. I haven't done the unit house split because it gets too complicated. And I saw that Chisel asked for Adelaide, so let me just try and do Adelaide, which is what, for 5,000. Okay, so this is Adelaide. Again, looking at net rental yield, and you can see that the scale is showing you the percentages in terms of the drops. The red numbers are the most deeply negative. And again, as you pull out, you can see there are a few areas that are actually underwater in terms of net yield. So south and north, 5043, for example, is one that jumps out at me. 5084 and 5014 also. And as you pull out further, you can begin to see the same trend. So it's patchy. There are others where things are quite a lot better. And here in this part, things are not looking too bad at all. So again, it's important to look granularly at this. So that's, I think, as far as I'm going to take the discussion with regards to the stress mapping. But what I will say is that I do have my, I do have my postcode engine on board. So if you're interested in particular postcode data, then let me know and I'll see what I can do for you. And I will just show you this because I've remembered tonight. I always have my other camera on, but the number of times that I forget to even switch to it. But there you go. I decided to do that now, and I saw a couple of people asking for information about Hobart, Perth and Darwin. Okay, let me just do that quickly then, seeing as I got the information here. Control F. Okay, let's do Hobart. Again, this is the net investor rental yields. They're doing pretty well. There's a couple of wobbles, but really nothing too bad at all in and around Hobart. And that's, of course, partly because of the lack of supply. Rents have gone up quite a lot in Hobart, and in fact, many locals can't afford to buy anymore, so that's not looking too bad at all. If I then go to Darwin, now obviously Darwin is a different kettle of fish because it's a relatively small geography, but you can see there that there isn't a huge amount of difficulty there. One of the things I'd say is that rentals are actually quite strong in Darwin, and the returns are looking quite good there. So Darwin's a pretty good area. Let's have a look. Hobart, Perth and Darwin. Now I've done them all now, so there you go. Now let me then just come back to this for a minute, and what I'm going to do is just quickly look back over some of the comments, and we'll go from there and see what we cover. Sorry, I've not been looking at the comments. It's all very much trying to do everything at once. Firstly, I just want to say very much thanks to Debt and Regret. McDonald's and Americans are paying $50 to people just turn up to a job interview due to the unemployment benefits. Yep, that's very true, and there's a few weird behaviours going on around the world. Agree with that. James said the RBA data is science fiction. Let's make George Lucas the governor. Well, you could do worse. You could do a lot worse. Comfy says, I want Biden's bucks helicopter money. Yeah, Well, they're certainly doing it big relative to us. Now, I think our budget will be quite expansionary. That's what as Frydenberg said. Probably, I think it's going to be probably that. But we'll see. I suspect they're still going to follow their old liberal practices, so it's going to be skewed towards, particular segments of the population, particularly construction sector. Although, interestingly, there's been a lot of discussion about whether the budget would actually throw money at the female sector of the workforce to try and get them back in. So we'll see. That might be a way of trying to drive it. Now, so Cookie says 5.6% unemployment, yet Minister stated there's 1.2 million dole bludgers. Go figure. You can't join the dots. That's why I think there's a real issue with the numbers. And I still think we've got a long way to play out. My point is that, remember, it's only a month after JobKeeper and JobSeeker's finished. It will take a lot longer for that to percolate through. Aussie Gene says, what is SQM? Square Meter Research. So that's Louis Christopher's data research company. It's the one that I use quite often because I think it's got a more realistic view of the data relative to some of the others. He's got I think, a more balanced approach to analysing the data. Master Singles says her first home buyer grants are ending around June, yet housing affordability is still atrocious. It's awful. It's got worse, of course. Housing affordability is worse because the loans are 15% bigger than they were a year ago for first-time buyers. They had all that stimulus package. There's the Bank of Mum and Dad. If you saw my ABC outing yesterday, there's a couple of them actually, one on the business and one on News 24. That's all about the fact that mums and dads are giving their kids cash to be able to go buy property. At the moment, that's all, distorting affordability even more. So we've got this really distorted market rather than actually a market that is really aligned to realities. I wouldn't be surprised to see more stimulus for property. Suka sort of hinted last week that they might do something in the high-rise sector to try and encourage people to buy high-rise properties. Well, I wonder why they might do that. Well, it could be something to do with the fact that those big construction companies are having huge difficulty selling those properties at the moment. So maybe they'll do something. Could be a tax break. It could be maybe they'll be even bought and then relent on. I don't know. Who knows? The mind boggles. I don't think we've seen the end of the construction support programs, or as I said in my interview yesterday, the bank support programs, because that's really what it was about. And it's interesting because they said, don't worry, RBA will own the entire bond market in a year or two. Yeah, if they go on at that rate, they will. Of course, they'll have to sort of slow down, but it's worth reflecting on how much the Japanese market is being affected by the central bank. They're just keeping to buy more and more of the market. They own the largest share of the market than any central bank around the world. They've also got, of course, 100-year mortgages in Japan as well. So, and they still got no inflation. So it tells me that this is not necessarily going to play out the way that perhaps some think it will. Okay, what else have we got? So AI asks, where's the tipping point? Well, the tipping point is timing related rather than actually just trajectory related, right? If this goes on for a long time, more people are going to fall over. So mortgage stress is not something that you trip over immediately. People can struggle through for a few months, but eventually it comes to a point where they can't struggle through anymore. And once they can't struggle through anymore, that's when they get into difficulty, and then it takes 6 to 12 months for it to work through. So I would expect to see mortgage stress continue to rise. Defaults, though, won't necessarily follow immediately. It might take several months or even years to come through. Zach asked an interesting question. What about zombie SMEs? Yes, I do have SME data. And the proportion of SMEs who are saying that they are still struggling has dropped. It was about 1/3. It's now about 20%. So 20% of SMEs are still saying they can't see a way through. A lot of those are in the travel, entertainment and hospitality area. but also others now in other sectors too. A lot of retail are also struggling still. And in fact, if you look at small retail, and you look in small retail settings, you'll see just many, many vacant shops. The retail sector is not feeling the love yet. Certainly not universally. So that's another sector which is under difficulty. Okay, what else have we got? Cookie Boy says ABS stands for all bullshit. Well, I don't know. The ABS claim to be, dealing with real data, but I sometimes wonder, I have to say. And Master Singleton said, Chipping Norton and Blacktown, not surprised to see them on the list. No, unfortunately, me neither. It's just, what you just expect. The point is, stress is where you expect to see it, right? That, unfortunately. But it's also in places where you don't expect to see it, like some of the more affluent areas too. And the Central Coast is one that people find quite surprised to find, but it's still there. So it is quite interesting how things are moving. What else have we got? Just going down the comments now. A lot of comments. And please like the post, folks. I want to try and get as many likes as I can. It really does help with the propagation of the show. The point, of course, with all of this is that it's a point in time, but it's changing each month. And each time I update the data, I then get a series of changes. Aussie GN likes the graphs. Great. Good to see that. Yeah. And Jason said a sea of red. Yes, particularly around Melbourne. Do I follow property activity in Perth? I do. I cover it across the whole of the country. Just about no rental vacancies in Perth, so rents are going through the roof. Yes, I agree about that too. That's what I said earlier on, that in fact in Perth, some of the rents have gone up a lot. Also, there's a story of people being pushed out and them reletting at a much higher rate because, of course, the protections that were there have gone away. So we're seeing that in Perth and elsewhere as well now. Master Single says Burwood and Strathfield are all right, not too much of a major loss. No, that's true. Not as bad as some of the further out ones at the moment. And James says expensive suburbs are asset rich, cash poor. That's true. Many of them are highly leveraged. Many of them, of course, are struggling with multiple properties, multiple investment properties. So that's why some of that investor stress at the high end is also there as well. I did Adelaide, which is last about Adelaide. I've done Adelaide, so I hope that's giving you what you wanted there. I've done Hobart, Perth. That's good. Now, Craigieburn, says Samir. Tell me about Craigieburn. Now, that is going to be an interesting one to do. So let's just go over there. I just need to switch my mouse to this other computer, and then I can explain what I'm doing here. Okay. So this is the online portal, which people can now get access to if you're actually subscribed at the appropriate level in Patreon. And within that, you get the stress information. There's also a category where you can get projection information. And there will also be some compare tools as well. The ability to download the data set. And also you can send feedback. So that's all within the model. I'm going to be using a special tab that I have, which allows me to put all the information into one tab. And whilst the portal for those who've got access, and everybody on Patreon at that signed up level has access now, I'm using the April data rather than the March data. So this is 2135, and that includes 2135, yeah. Okay, 2135, and then I'll do Craigieburn. I've confused myself. Hang on. Let me just put it in the right order. 3064, and then I'll do. 3064. 3064. Unfortunately, I can't type. It's a bit of a problem, really. Okay, and I can probably just make the text a bit bigger. How's that? Okay, so this is 3064, Craigieburn, Mickleham, Roxburgh, so north of the city, up towards Melbourne Airport. 23,000 households, 15,000 borrowing, 8,000 renting, 6,000 properties for rent, and 7,000 property investors in the area. 53% in financial stress overall. Within that, mortgage stress, so there's a cash flow assessment of those with a mortgage. 6,200 are stressed. That's 41% of mortgage holders in stress. 3% risking default, or 392 over the next 12 months. Rental stress is pretty high at 65%, that's 5,100. And investor stress is sitting at 17%, which is around 798. So that's that one. And I've also just included some of the price changes. So the three scenarios in the really bullish case. So assuming that the virus gets locked down quickly and everything opens up, then it all moves ahead. And you might see home prices for houses up, say, 11% over 3 years. Units, about 8% over 3 years. But the neutral stance is not so high. And in a second, I'll go back and just show you why I talk about these three scenarios in my overall scenarios, because it's worth just getting up to the speed with those scenarios again. But the sort of neutral one is where effectively the virus hangs around for longer, the borders stay closed for longer, the rollout of the vaccines take for longer. And the worst case is when we get a third wave, and if we get a third wave, then effectively we're predicting the potential falls in prices. So that's that one. Now let me do 2135, which was one that I saw being asked for. Let's put that up there. Press that. 2135. Okay. 2135. So this is Strathfield, 8,800 households, 2,300 borrowings, 4,600 renting, 3,400 properties for rent, and 2,400 rental property owners, 42% in financial stress. Mortgage stress is pretty low, only about 10%, and that means that you've got about 240 people there. Bit of default risk, but not a lot. But half of renters are in difficulty from a rental stress perspective, 50%, and 54% of investors are struggling. So that's really the nexus in this particular postcode. It's not really an owner-occupied problem. It's a renter and investor problem. And we quite often see that in these sorts of postcodes, where effectively what you have is the ability to have the combination of renters struggling and investors struggling at the same time. So that's that one. Now let me just come back to here. Whoops. I have the technology. Well, it's sort of working, isn't it? It's quite neat when it works the way I want it to work. It doesn't always, but it's very good. Now, what's this one here? Okay, let's go there. How's 6066 looking? I'll have a look for you. 6066. I'm just going to put it in first before I put it up. Now, I love this, where we actually look at postcodes I've never heard of. So this is all very exciting, isn't it? Okay, 6066. There you go. So there you've got it's Balladura. I think that's right, Balladura. 6,600, of which 4,000 are borrowing, 1,700 renting, 1,300 properties for rent, and 1,200 investors. 42% in financial stress, 52% in mortgage stress, so that's higher than some of the other ones, 2,100. 3% risking default, 28% of those renting in difficulty, and only 10% investors. So here, the real story here is to do with mortgage stress rather than the investment side of the house. So that's what's really driving the performance of the market there. I like that one. James says, Martin, SpaceX North. Yeah, it's a bit like that. I mean, I don't know what you think about my setup here. I mean, how much you can see from this, but we do have a bit of tech around us, right? And to make it all work, there's a lot of tech behind the scenes as well, just to keep everything working together. So it is a bit of an interesting technical challenge. When it all goes right, it's perfect. When it doesn't go right, it's less than perfect, but that's okay. Even SpaceX has a few accidents from time to time. Now, there was this one here I saw. Let's do cross stitch. Hi, cross stitch Ange. How you going? You wanted postcode. So let's put that one in, see where we go. 3328. Teesdale. Okay, let me go back there and get rid of that. There you go. Okay, pretty small postcode in a regional, 613 households, 38% in financial stress, 459 borrowing, a few renting, not many, 50% in mortgage stress, 230. I'm not seeing really any rental stress or investor stress in the postcode. That, of course, may be because the total numbers we're dealing with is quite small. Remember that it's a 0.5% sample that I have in the survey. So in some small postcodes, the accuracy does degrade, but nevertheless, that's a reasonable estimate, I think, what's going on there. Style Play says Coleroy 2097. Yep, can do that. And those with the subscription service can actually do this for themselves and basically look at whatever they want to. And you can also make comparisons between the different postcodes too, which is also quite interesting, right? This is Coleroy, 5,600 households, 2,600 borrowing, 1,800 renting, 1,400 properties for rent, 1,900 rental property owners, so that's quite a few investors, 30% in financial stress, 15% in mortgage stress, that's pretty low, 20% in rental stress, that's pretty low, but look at this, stressed investors, so those in the property investment sector, 913 or 53% are struggling with renting the property or looking to try and get a higher rent or otherwise make it economic. What I would say is that those with higher investor stress signal postcodes where effectively they are more likely to sell the property. That's why I believe that we're going to see considerable amounts of property coming on, particularly from investors over the next little while. Cookie Boy has asked for a postcode. Try and help that to 2300 Newcastle and places like that. I did a show the other day on Newcastle, part of Newcastle, which was quite interesting. I quite enjoyed researching that one because it's not an area I looked at in detail. So it's on the channel if you want to go look. Okay, let's have a look. Newcastle. What happened there? 2300. I didn't. 23. Helps if I actually put it in. Okay, there you go. 6,200 in that postcode, 1,200 borrowing, 4,000 renting, 3,000 properties for rent, 1,500 rental property owners, financial stress at 24%, mortgage stress sitting at 57%, the risk of default over 12 months at 3% or 34%. 14% in rental stress, 13% in investor stress. So mortgage stress is the story, and just in terms of projections over the next 12 months, if we get out of the COVID quickly, could see a bullish case of, let's say, 12% over 3 years for houses and about 9% for units. The less bullish or neutral one is down over the next couple of years, and that's the same also for the units as well. So that's that one. All right, what else have we got? Can I do Balcombe Hills? Yes, I can. That one's from Hamid. Yep, Balcombe Hills coming up. Balcombe Hills 2153. Oops, Balcombe Hills. There you go. All right, here we come. Balcombe Hills. Okay, 19,000 households, 10,000 borrowing, 4,800 renting, 3,700 properties for rent, 5,900 rental property owners, and 38% in financial stress. Mortgage stress is at 17%, but rental stress is at 77%. That's very high, 3,700 in rental stress, 38% or 1,800 investors. So this is again where you've got the investor conundrum. So I would expect to see a number of property investors deciding to up and out in that particular area in the next few months. Okay, I'll do a couple more and then I'll just look at some broader questions, because obviously doing postcodes is quite fun, but I'm sure people are asking a few other questions too, so I'll try and get some of those as well. Okay, I'm doing 4128 for Jonathan there, 4128. Let's push that button there, there you go. So this is Schindler Park, 5973 households, 5,900, 3,600 borrowing, 1,700 renting, 1,300 properties for rent. Number of rental property owners, 2,200, 88% in financial stress. And that is because 85% of households show up as mortgage stressed. 85%, that's 3,000. That's a very, very high number. That's a considerable worry. 85% of rental people are also in difficulty, and 32% of investors. So this is a really complex situation where both mortgage holders and property renters are feeling the pinch. And that said, prices in the bullish case could go up a little over the next couple of years, but on the bearish, not so, and units not so much as houses. So that's that one. Okay. Coral Rock, I don't know where Coral Rock is. 3934. Where is Coral Rock? 3934. It's a great 3934, 3934. It says Mount Martha. I hope that's right. 8,000 households, 3,800 borrowing, 2,800 renting, 2,100 in properties for rent, 3,300 rental property owners, 53% in financial stress, 60% in mortgage stress. That's 1,900, so mortgage stress problem. 42% in rental stress, so some rental, 29% in investor stress. So it's not too bad from the investor side, but the rental stress is quite the mortgage stress is quite high. And again, we're seeing some trajectory on the upside, not huge, but it depends on the scenarios, of course. And units, again, performing less well than houses. Houses generally are performing better at the moment in most of my modelling. And that's a combination of supply and demand, as well as the issue relating to some of the poor quality construction for some units in some areas. Okay. Interesting. Anthony asked me this question. Do the price changes take into account home buyer depth in the market and likely future demand from home buyers? Yes, it does. So I have in each of in each postcode, I know what the distribution is by segment. I know how many are looking. I know what their sort of price ranges are, and I know essentially what the volume is. So how many, where they're looking, what they're looking for. So that's all in the model. That includes also property investors as well as owner occupiers. It's all segmented. It's also overlaid by some of the other external data that I've got, such as, for example, the lending standards and those sorts of things are there too. So it tries to get a view as to what may happen. No, it's not completely accurate. It's not a prediction. It's just an estimate based on today. But over time, you can see how these trends change. And as I say, if you want to do some comparisons, you can go back and make some comparisons from previously if you've got access to the tool. And some people using the Patreon sign up can get access to that. If you want to, you have to sign up for the stress tool, and that then gives you access to this at the moment. We will be taking it into other areas. For example, those investor return numbers that I showed you on the maps, we'll be including those in the model shortly, and that will then give another dimension too. We may well create another tier within the model so that effectively there are different things that people can get access to depending on what they actually want. So watch this space. I'm working with some developers to take this into some further directions. And interestingly, just to underscore, those people who are actually already signed up, Normally, I would send out the spreadsheet with the email, but now what we're going to do is allow you to download the spreadsheet directly from the system using the download file for those who've signed up. And just to be clear, you basically go into the download and then you can click on there to download the last available file. That, of course, will be updated to the April file shortly. That's how it's done. And that means that I don't then have to send the file out to everybody independently, which of course takes time and effort and bandwidth. So that's a more efficient way, and that's what we're trying to do. James, thank you. One large hazelnut latte with almond milk, $6. Thank you very much. Appreciate it. I can taste the almond now. I love nuts. It's good. Okay, Cookie Boy says that's interesting. 24,695 properties for lease was over 32,000 last year. Question is, are developers moving properties for lease to stop rent prices from falling further? Yeah, they are absolutely controlling the flow onto the market at the moment. In fact, Edmund and I covered this in a show a couple of weeks ago. So rather than putting 20 on at once, what they're doing is just drip feeding them and trying to shift them. They're not being very successful at the moment. As I said earlier on, a lot of foreigners are actually selling rather than buying. A lot of people are still very nervous about buying, particularly high-rise. And so the stock of unsold high-rise is going through the roof. That's one reason why I think Sukker is quite likely to announce something in the budget, or via the budget, to buy some of that off those developers. Because if they don't actually succeed in selling them quite soon, that's going to be a real problem down the track for them. Evan threw this question out. What are your thoughts on using a perpetual bond as a way of saving the debt bomb? Well, yeah. Now, this is getting very interesting, right? Because what you're actually highlighting here is a couple of fundamental questions, right? The first is, governments can raise a lot of money. The MMT theory is they don't really have to pay it back. They just keep rolling it or issuing perpetual bonds. And there's got no limit to what they can do. It's not like a household budget. So they could create a huge amount of liquidity. The question is, though, what do they do with it? Where does the money go? So John Adams and I made a show the other day, and we highlighted the fact that nearly $1 trillion has been spent by federal and state over the last year in a direct response to COVID. Now, that debt is still on the balance sheet, right? And it won't get paid off anytime soon. Now, they can go on doing that, but the question is, how much of that $1 trillion went into productive, strategic, long-term developments, and how much of it went into tactical, short-term, propping up the votes, propping up the construction sector, etc., etc.? The answer is almost none of it was strategic. And that's the problem. And I think a lot of the MMT people will say, well, sure, you can create a pool of value from issuing those long bonds, but you've got to put the money in the right things. You've got to put them in the right strategic projects. You've got to invest in the future. What you can't do is to use it just for current expenditure, just like any other expenditure, and just buy votes in the short-term cycle. Because if you don't expand the economy and create more momentum, you'll never create enough value in the economy to repay the debt later. So the question is, can you never repay the debt? Well, there are perpetual bonds out there that have never been repaid. The question is, if you go on doing that, at what point does the currency then get hit? Because people get worried about the economy. And at what point does the quantum of debt really start to haunt prospective investors? That's the question. The other side of it, and this is the thing that I think people haven't got hold of yet. People talk about buying a property is better than renting a property. Well, remember, if you're buying a property with a mortgage, you don't really own the property, the bank does, right? You're continuing to pay a cash flow stream. Now, if you have a mortgage that's 30, 40, 50 years, or 100 years in the case of Japan, it is perpetual mortgage repayments. Now, I want to ask you a question. Consider this. What's the difference between paying a rent to a renter, to a landlord, and paying a mortgage repayment on a perpetual basis to a bank? Well, the answer is, if you pay off the loan, you might get the property, but if you never pay off the loan, you don't get the property. And that is the essence of you will not own anything but be happy, which is of course the World Economic Forum sort of mantra, which I'll probably talk about in the future post. That's what they're talking about. It gets to the point where effectively nothing is owned, everything is rented, and the rent seekers, those are the banks, hedge funds, other players, just love that because they can see this perpetual flow of cash into the future. And that means that we as individuals and businesses are reduced to being a perpetual cash flow. And our role in society is continue to pay and pay and pay and pay and pay, right? That is the future that I see. And perpetual bonds is just part of that overall picture. So that's why I'm of the view that this is a very slippery slope we're going down. I'm not sure there's a way back, but I think we should at least be going in with our eyes open rather than just saying, oh, everything's going to be fine. I'm not sure that's going to be the case. Okay, Zach asked this question. Do you have a stress scenario in case of a third COVID wave with a distinct inflation? Yeah, so let me switch across to my scenarios and I'll just explain how I do that, because I have got a number of scenarios that I actually do look at, and it is quite important to understand the way that it operates. Let me just go back there so I can get to my, oops, where's that? Okay, so let me just get rid of that and put that up. Okay, so in our scenarios, what we're doing is looking at different futures and considering the consequences. It's not a forecast, it's just basically to talk about what may happen. And in my scenarios, this is now the latest set that I have. So basically I have the RBA baseline one, which is essentially updated from what was said today. And in that one, over the next 2 or 3 years, I can see home prices could be up to 35% higher from where they are. The unemployment rate would be at 4.5%. The mortgage stress will be back to 32%. The losses would be very low. And I give that about a 10% probability. I think I'm being generous there. I think it's highly unlikely that we're going to see that in the next 2 to 3 years, but that's what the Reserve Bank is saying. Then I have my scenario, which is what I call my best case. Now, this is the best case that I use in my modelling, which is the one I showed you previously. So there, I'm saying the unemployment rate will be about 5%, the mortgage stress will be about 35%, the bank loss is about 12 basis points, and I sting in that scenario a price scenario of up to 25% higher in some places or small falls in others. That varies, of course, by state, location, those sorts of things. And I give that a 50% weighting. So I'm assuming that we might get it all under control in the next few months. But there's also equally a risk that we don't. And I call that the longer term crunch. So that's when the rollout of the vaccine takes a lot longer, when we get more small infections, where we get a lot of difficulty with trying to deal with all of the various issues, and the economy sort of doesn't really fire, it just sort of hobbles off. And of course the stimulus has continued to be withdrawn. So 6% unemployment, 4% mortgage stress. And in that scenario, I think home prices are sort of down 20 to 30% on average. It varies, of course, by location and type of property. And that has a 30% scenario. And then I have 2 other scenarios. And going back to your question, Zach, where you asked about the question of the distinct Indian flavour, well, that would be the multi-wave disruption. This will be a wave 3 of infections, where effectively we follow some of the other countries in the Northern Hemisphere. In that scenario, we would see the RBA forced to take rates to 0 and below. The unemployment rate would go up again. Mortgage stress would be even higher. And in that case, I think prices would be significantly lower. And there's also a risk of a bank potentially getting bailed in or bailed out in that scenario. Only a 5% probability at the moment, but I'm watching this closely, because if the situation with India and other places internationally doesn't get sorted out quickly, that could be much higher. And then there is also this question, well, could it mutate to the point where it becomes completely under control? In other words, could we have a global India? Is that feasible? May not be now. Got a 5% chance. And in that case, all bets are off. Basically, things could go really, really pear-shaped. But that's not my central scenario. So my central scenario at the moment is still just the best case scenario at 50%. I don't believe the Reserve Bank scenario is accurate. I don't necessarily subscribe that it's going to be easy to get the best case scenario, but the longer term crunch is also there to be considered. And those 3 ones in the middle are the 3 that drive the scenarios in my earlier modelling. which I showed in the modelling just a little earlier on. So that's how it works. So that's the scenarios, and that's how the scenarios in my modelling actually works. Okay, what else have we got? Interesting question. Have I factored in World War? No, I haven't. Not directly, although, of course, the drums of war, unfortunately, are, according to some, sounding loud. I think that's a bit of a deflection, frankly. But you know, the fact is that there are a bunch of externalities which are hard to model. But you know, if I see the need, I can always include that later, I suppose. But they're not in there at the moment. Okay, Matt says 4573 would be great. Okay, let's see whether I can do 4573 for you. Oops. Just need to switch back. And just to explain, I've got multiple computers all running at the same time here. One of my problems is that I've only got one mouse set. I've tried using multiple keyboards and mice at the same time, and it's just getting too complicated. So I basically switch my mice and things around. It just takes a second to switch. 4573, 4573. Okay, here we go. Coming on. 4573. This is places like Coolum Beach, Mount Coolum. Love it. Nice part of the world I really like. I've been there many times. Numbers of household, 12,000, 4,000 borrowing, 6,000 renting, 4,700 properties for rent, 5,000 rental property owners, 37% in financial stress, 13% in mortgage stress, that's pretty low, 23% in rental stress, pretty low, higher, 53% in investor stress. And that's one of the interesting things. There are pockets in Queensland where investors still aren't making huge returns, because whilst the returns might be a little higher than in some other places, they are still relatively slight. And so that's why we've got 53% there. So not an immediate worry from a mortgage stress perspective, but property investors, yeah, you might want to check what your rents are and see what the story is. Okay. Another one here. Whoops. Let's go back there, shall we? That. There you go. Okay. Now, let's go back to there. Okay. Rowville. Push the wrong button. 3178. 3178. 3178. Rowville. Okay, this is Rowville. I'll get rid of that so you can see it. 11,600 households, 6,900 borrowing, 2,700 renting, 2,000 properties for rent, 60% in financial stress, comprising 79% in mortgage stress, which is 5,400, 50% in rental stress at 1,300, and just 8% in investor stress. So this is a mortgage stress-led issue, and you can see again the price movements. You know, considerable uplift potentially ahead, 11% over 3 years maybe, but if the neutral case, it's much lower, about 2%, and the worst case is down. So that's pretty consistent with many other postcodes that I've looked at as well. And so I hope that's helpful. I've quite a few people asking for postcodes. Different colour keyboards would help. Yes, Cookie. If I had the space, I don't necessarily have the space to do all of the things that I want. It would just be very, very confusing. Okay, let me just pick up that one. This is from Hayley. Thank you very much for the super chat, Hayley. I really appreciate it. And it does work. You see, you got to the top of the queue. I've got quite a lot of people asking for postcode data, but you jumped the queue. That's what it's about. Okay, so 36,000. This is 4670 Bundaberg, etc. 11,000 borrowing, 16,000 renting, 12,500 properties for rent, 12,800 rental property owners, 34% in financial stress. 18% in mortgage stress, that's pretty good. Rental stress at 39%, 6,400. And investor stress at 35%, 4,000. So this is more on the investor side. You know, not dramatic compared with some others, but still a bit of a worry. The overall financial stress level is below the national average. And price is looking quite strong. I'm actually, in my bullish case, suggesting that house prices could be up 70% over 3 years in that particular area. Even in the neutral scenario, it's 8%. And in the bearish case, it's no change. So that's where that works. Units, not so much, 12, 6. And again, not much movement. So that's that one. Okay. Red Blower asks for 7178. 7178. 7178. That's not coming up. So that's possibly because it's a small sample. Yeah, let's just check. No, it's not there. Sorry, can't do 7178. So I don't know where that one is. Could be a small sample. Okay. That's an interesting one from Donovan. I'd love to see 3163. Well, let's try that one first. 3163. Right. 3163. This is Carnegie and Huntley, a place like that. 14,800 households, 4,800 borrowing, 7,700 renting, 5,900 properties for rent, 5,700 rental property owners, 43% in financial stress. So that's a little bit higher than some, but not as high as some of them we've seen. 44% in mortgage stress, 2,000, 22% in rental stress, but 47% in investor stress, 2,600. So there is a conundrum here with property investors. It goes back to those low returns that I showed you earlier on, I think. Wheat Chief Farming asks for Ballarat, 3350. Okay, so here we go, 3350, 26,700 households, 9,500 borrowing, 12,000 renting, 9,400 properties for rent, 5,800 rental property owners. I will just point out there's an interesting relationship between the number of properties and the number of rental property owners. It does vary across different types of areas of postcode. 55% in rental and financial stress, 79% in mortgage stress. So mortgage stress is very high in Ballarat. Do you remember those charts where I showed you the red? That's why, 79%. 47% in rental stress, pretty high. 22% in investor stress. So again, it's a mortgage stress-led issue. And over 3 years, best case about 10% higher for houses and around 7% for units. But in the mid case, a significant fall over the next couple of years, and the same for units as well. So it does depend on the virus and what happens. And here's another one. Lots of requests coming in, which I'm happy to answer, but I'm conscious of time running by, and I'm going to eventually run out of smoke. 3145. 3145. Look up. Oh, that's not right. What happened there? 3145. Yep. Operator error. Okay, 9,500 households. This is Caulfield East, Central Park, Darling, Malvern East. 9,500. 3,200 borrowing, 4,100 renting, 3,100 properties for rent, 3,900 rental property owners, 44% in financial stress. So that's the top level. Drop down, 28% in mortgage stress, that's pretty low. 6% default, that's a bit high. I know that in this particular postcode there are a few people who had significant support from the banks until right up to the end of the March, and then now they're struggling, so that's why that's high. 37% in rental stress, 52% in investor stress, 1,700 households, and investor stress is quite high, so that's why overall financial stress is where it is. And of that, the investor side looks quite weak. Overall bullish case maybe 12% over 3 years. The bearish case down 5% over 3 years. Units not performing so well is what I'm seeing in my modelling at the moment. 927. Okay. Glen Waverley. A lot of Melburnians on tonight. Very good. Glen Waverley, there you go. Glen Waverley, look it up. 22,600 in Glen Waverley households. 7,300 renting. 5,400 for rent. 7,700 property owners. And 32% in financial stress. Very low mortgage stress, 11%. 58% in rental stress, so rental stress is a real issue. And 33% in investor stress. And I wonder whether the rental stress has something to do with the fact that Monash University is just around the corner. I think it probably might be. And so that probably explains it. And in fact, Kim did actually ask me again. So there you go. Thank you very much for the super chat. I really appreciate it. And I hope that information was useful. Okay. Another one. 3018. 3018. Altona. 3018. This is for Daniel. 5,900 households, 1,800 borrowing, 2,500 renting, 1,900 properties for rent, 2,072 properties owned by investors, 42% in financial stress, 41% in mortgage stress, 39% in rental stress, 36% in investor stress. So it's pretty evenly spread. And again, over 3 years, maybe 10, 11%. Over the next 12 months, we're looking at maybe 1%, 2%, and the 4% over the second year. That's in the best case scenarios. Other scenarios, not so good. Oh, Cookie Boy, what are you doing to me? Cookie wants me to go on till 10 o'clock. I'm not sure I can cope with 10 o'clock. We'll go on for a bit longer anyway, because there's lots of people wanting information, and I'll try and help out where I can. Very good. $3018, done that one, so that's good. Brisbane 4509 says Jeremy. 4509. 4509. Mango Hill. North Lakes. Okay. So 10,600 households, 4,800 borrowing, 5,500 renting, 4,100 for rent, 3,400 rental property owners, 53% in stress, 28% of mortgage stress, 60% in rental stress, so rental stress is the problem, and 42% in property investors. So that's the real problem rather than mortgage stress. And there again, we're seeing bullish case of 15% over the next 3 years potentially for houses if things go really well, or a fall of 1.7% if things go less well. And for units, 11% on the best, down 1% on the worst. All right, now what I'm going to do is I'm just going to come back and just finish off the formal part of the show, and then if people want to hang with me for a bit longer, I'm happy to do a few more postcodes afterwards, because I know that there are people still asking for more postcodes, and I'm happy to spend a bit more time helping to cover the backlog. But let me just finish off Let's go through there. Just to say that if you are interested in more about what we do, you can go to whattheworld.com.au, and of course we tie up with Nucleus Wealth and we cover a lot of issues to do with wealth management and investment as well. So that's worth knowing, and that's where the What the World comes from. Our DFA blog contains a lot more data about what we do, and if you haven't signed up on the DFA blog, do that. You can get a notification every time we make a post, and all of the shows that we produce, including those on other channels, are also included there. And I do make other shows for other channels. There's one up there at the moment, which I posted today, in fact. You can support our work via Patreon, and just to explain that those various membership levels give different levels of access to information. But the $50 per month is the one that gives you access to the stress data. That is the one that gives you access to all the information in the portal. So if you want to get access to the portal that I've shown you tonight directly, you can by going across to Patreon and signing up at the $50 or the 65 Aussie dollar, depending on which currency you've set it up as. And you can sign up there, and you then get the information every month that you're actually at that tier. That information gives you complete access to all the stress information, and I'm previewing at the moment the projection data that I'm showing here as well, and that is available as part of the membership at the moment. So go across to Patreon if you want more information. The link is there at the bottom. You can also, if you want a one-to-one conversation about a particular suburb, I do that. I do my one-to-one conversation, and I do have quite a few of those running at the moment. I can't give specific financial advice, but I can deep dive into a suburb and really look in detail, talk about all the underlying trends. I can assemble the stress data, the home price, the trend data, and also pull data from my modelling, and that gives a view of what we can see. We can do a Zoom or a phone conversation up to about an hour. And there is a cost involved because there's a lot of research. It takes me a day or so to prepare one of those. And so if you're interested, go to the DFA blog or contact me, and we can explore it. Booking's about 3 to 5 weeks ahead at the moment, simply because there's a lot of people wanting those conversations. But if you have a really urgent case, I can sometimes help out in the short term. So that's just that one. You can also make a contribution if you'd like to help us. We don't make a profit from all the stuff we do here. We're not in business to make a profit, frankly. We're in business to help people and to share the information that we have. We think there's a really important job to be done, simply to help people understand what's really going on in the property market and in the broader economy. So if you'd like to support what we do, you can do that via PayPal as well. So PayPal, Patreon, and even Bitcoin. We actually have a thing there that you can scan and make a contribution via Bitcoin if you prefer. And all contributions greatly received. It just helps us to make more content. We've also got some merch, which I just briefly touch on each time, just because it's something which you do. But next time, I should just tell you, I've got Robbie Barbican, and we're going to talk about what I call current state, future state. Robbie Barbican is from the Citizens Party, and Robert and I will be talking about the Great Reset, what it means, what are the foundational elements, the assumptions behind it, what could the future look like, and we will touch on some of their policy thoughts, some of my thoughts, going back to that chart I showed earlier on about the 80-year cycle, what comes next is all part of that same conversation. So that's the 11th of May at 8 p.m. Sydney time, so mark your diaries and make sure that you come back and see us again then. And with that, I really appreciate all of those who've hung with me to the end of the show, and thank you very much for the super chat, Zach. I really do appreciate it, and very, very appreciative of all those who've made a contribution tonight. I think I've acknowledged them all, but if I haven't, then I apologise. There's a lot of stuff going on. There's quite a few things to try and control at the same time. Vanessa says, Jason, see you next week. Yeah, good. Yeah, very good. Okay. Hungry for more data next time? Yeah, plenty of data around. Get in the ring with Comic. Yeah, well, it should be fun. I think Robbie Bart will be really interesting. And in fact, the fact of the matter is that there's a lot we can talk about beyond Aussie Post and cash bans and things. So I'm trying to sort of take the big picture, the philosophical picture. Okay, now let's have a quick look. Boundless Nature asked about Avalon 2170. So now what I'm going to do, for those still with me, if you're interested in just hanging on a bit longer, I'll go through a few more postcodes just for a few minutes more. I don't promise to do them all, but I'll try and do a few more. And then I'll tell you at the end, if you've still got a postcode request, what you can do to get information after the show. There is a way of doing it, but if I can do it now, then I sort of meet everybody's requirements, of course, in real time. Okay, so we're looking at Avalon. Interesting postcode, actually, Avalon. I quite often have a look at that one. Okay, 5,800 households, 2,500 borrowing, 1,700 renting, 1,300 properties for rent, 1,800 rental property owners, investors, 44% in financial stress, 48% in mortgage stress, that's 557, a few in severe stress. See, that's 666, that's quite a lot in severe stress. So there's a lot of people under financial pressure in this particular postcode. 35% in rental stress, 600, and 56%, 747, in investor stress, with some in severe stress. And price predictions, estimates, 10% over 3 years. Best case for houses, 7.5% for units. Worst case scenarios, not so strong. So that's that one. Okay. Can I do a comparison between Doncaster East and Templestowe, please? Maybe. Hang on, let's see. You need to give me the postcodes. I don't know what they are. I can't look them up easily. 2107 I did. Tamworth says, there you go. How's that? SCVTT. I have no idea how I would pronounce that. I'm not even going to try it this time of night. Come on, 2, 3, 4, 0. Yeah. 2, 3, 4, 0, 2, 3, 4, 0. That's not Tamworth. Let's try TAM. Tamworth. 2, 3, 4, 0. It is. I must have mistyped it. Okay, look it up. Yep. That's me. User operator error again. Sorry. Okay, 21,000 households. 7,200 borrowing, 9,900 renting, 7,500 properties for rent. Number of rental property owners, 6,500, 65% in financial stress, 72% in mortgage stress, that's 5,000, 64% in rental stress, 44% in investor stress, which is why the financial stress number is so high. And there you go, a little bit of growth, but only about 8% over 3 years for houses, best case. Is what I'm seeing. And Cookie Boy's off. See you, Cookie. Thank you very much. All good. And I think other people are signing off too, so it looks as though I probably might. There's one more I'll do. 3754. 3754. Doreen. There we go. 13,300 households, 9,100 borrowing, 4,500 renting, 3,400 properties for rent, 2,800 rental property owners, 53% in financial stress, 47% in mortgage stress, 4,200, 51% in rental stress at 2,300, and 17% in investor stress. And the 12% over 3 years best case for houses, 8.8% best case for units, the mid case slight rise over 3 years in both cases. All right, that's it. I think I'm done. So Aidan wanted me to do Wollongong. I'm going to do a show on Wollongong, not least because I live close to Wollongong, but I will just give you those bare numbers now. It's quite an interesting situation. Oh dear, 2500. Come on. Do that. Wollongong. There we go. This is the last one for tonight, folks. Wollongong, 18,700 households, 4,200 borrowing, 11,000 renting, 8,500 properties for rent, 6,000 rental property owners, 60% in financial stress. And 40% of those with a mortgage, 1,700 in mortgage stress, and 61% in rental stress, and 51% in investor stress. So there's a fair amount of financial difficulty in the area. And looking at 10% max over 3 years for houses, and units at 7.5%. Best case scenario, worst case scenario will be down 7% for houses and down 5.8% for units. Okay, so if you have not got your information from me via this particular process this evening, I've come to an end. I've run out of smoke. You can send me a message via the DFA blog, and if you send me an email with your postcode that you want, I can send you back a snapshot as I've been showing you this evening for a particular postcode. So that's the way that you can get the information. I've run out of energy. You can see I've tearing my hair out a bit, so I think it's time to call it. So I look forward to seeing you next time around. And I just want to say thank you so much for all of you spending some time with me. I really have appreciated everybody there. And I hope that the information has been useful. Check back. I'll be doing it next month again. I'll always have the postcode tool. If you want specific information, send me an email. And for those who I didn't get to tonight, I apologise, but hopefully you can contact me directly if you'd like information. The smooth operator said a bad hair day. Yes, it was. Yeah, I must have done that subconsciously a few months ago when I was trying to work out what to do. So there you go. Okay, time for a rest. Thank you very much, Otto. I want to say cheerio to everybody. Have a good evening. Check back next week for a conversation with Robbie, and keep following us. Please like the show. Please share it. Please tell everybody about what we do here. It's really important. And I'll look forward to seeing you next time. This is Martin North from Digital Finance Analytics, signing off.